Well, good to be with you. I'm sitting here in my office in Omaha, Nebraska, the same one I've had for decades, looking out at the city I love. It's funny how some things just stick with you. I've been doing this investing business for a long, long time now. I bought my first stock, City Service Preferred, when I was just 11 years old, paid $38 a share for it, then it dropped to $27, which taught me a thing or two about patience even then, seeing it eventually go back up and selling it for a small profit. What I didn't learn from that first trade, which would cost me a lot more down the line, was how important it is to own a wonderful business, not just a cheap stock. And believe me, that lesson was drilled into me the hard way right here at Berkshire Hathaway itself. You see, the truth is, buying Berkshire Hathaway in the first place was a bonehead move, a mistake that probably cost us close to $200 billion over the years in opportunity cost. We bought into a textile company back in the early 1960s, a dying business, because it was what Ben Graham would have called a cigar butt. The stock was trading for less than the working capital, less than liquidation value. It was cheap, real cheap, and I could extract a little puff out of it, just like finding a cigar butt on the street with one last puff left. I started buying shares in 1962, thinking I could profit from its cheapness, maybe even liquidate it. But the textile business was a drain, an absolute capital hog. It ate money faster than we could generate it. Every year, we'd put more money into it, hoping for a turnaround, buying new machinery, trying new strategies. It was like throwing good money after bad, and I was too stubborn to admit it. The real turning point came in 1964. The CEO, Seabury Stanton, offered to buy back some shares that I agreed to sell a significant chunk of my shares to him. But then, to my surprise, he actually offered 11. Well, that made me mad. I'm a competitive fellow, always have been, and that nickel and dime difference just got under my skin. What a dumb reason to make a multi-million-dollar decision. Instead of selling, I decided to buy more, take control, and fire him. I bought more and more shares, eventually taking control in 1965, and then I owned the damn thing. I had taken a business that was barely treading water and decided to keep it afloat, just out of spite and ego. What a fool I was. We poured money into that textile operation for another 2 decades, chasing after a business that had no chance in a globalized economy. We finally shut down the textile operations. It was a classic example of trying to turn a sow's ear into a silk purse, and all it did was teach me a very expensive lesson about the importance of business quality. Here's what I learned from that stubborn mistake, and what Charlie Munger, my partner for so many years, really helped me understand. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Ben Graham taught me the importance of buying assets for less than they were worth, of having a margin of safety. And that's a rock solid principle, absolutely fundamental. But Ben was looking for statistically cheap stocks, cigar butts, businesses where you could make a quick buck on a liquidation or a short-term turnaround. He was a deep value investor. What Charlie helped me see, often over a bridge game or just sitting around the office, was that a truly great business, one with a durable competitive advantage, a moat, could compound your wealth year after year, even if you paid a bit more up front. It was a shift from thinking like a liquidator to thinking like a true business owner. Investing is really quite simple when you boil it down. It's about finding a business you understand that has good economics and that is run by honest and capable people. Then you buy it when it's trading at a reasonable price and you hold on to it. That's it. You don't need fancy math or a supercomputer. You just need patience and the ability to distinguish between a great business and a mediocre one. A great business acts like a compounding machine, working for you tirelessly, reinvesting its earnings at high rates of return. A mediocre business like our old textile mill just eats capital and delivers poor returns no matter how cheap you initially buy the stock. It's like planting a weed versus planting a sturdy oak tree. One will just take up space and maybe even hurt the other plants. The other will grow steadily and provide shade and fruit for generations. Charlie always tells me that if you keep doing something stupid, you're going to keep getting stupid results. And that textile business was the poster child for stupid results. It was a terrible business with no competitive moat, operating in an industry that was doomed in America. What we needed were businesses like See's Candies, which we bought in 1972. Now, See's wasn't cheap by traditional cigar butt metrics. We paid $25 million for it, which was 4 times its tangible book value, but it was generating $4 million pre-tax earnings at the time. And it had something the textile mill sorely lacked: pricing power and a beloved brand. People loved See's candies. They would line up to buy it, especially at Christmas and Valentine's Day. It had a qualitative Charlie practically had to drag me kicking and screaming to buy See's. I initially offered $20 million, which was more in line with my Graham style valuation. But Charlie, he just saw the magic. He said, Warren, what's the value of a business that can raise its prices 5 cents a box every year without losing a single customer? He was absolutely right. See's has generated over $2 billion in pre-tax profits for Berkshire since we bought it, all from that initial $25 million investment. And it didn't require any significant capital reinvestment from us. It was a cash cow, and it taught me the power of a consumer brand with a wide moat. That's what a wonderful business does. It makes money for you and doesn't constantly demand more capital. Another classic example, one that really drives home the idea of owning wonderful businesses, is Coca-Cola. We bought a big chunk of Coca-Cola in 1988, paying about $102 billion for 6.3% of the company. That was a huge bet for us at the time. What did we see? A simple business that makes a product people love all over the world. It's got an incredible brand, an unbeatable distribution system, and it generates immense cash flow. You don't have to be a rocket scientist to understand that business. You just look around. People in every corner of the globe are drinking Coke. It has a powerful, enduring moat. We still hold it today. That investment, even with all the ups and downs, has paid for itself many times over in dividends alone, not to mention the appreciation. It's an easy business to understand, and that's a key part of our philosophy. If I can't explain it simply, I don't understand it well enough to invest in it. We also learned this lesson with American Express back in 1964. They had what was called the salad oil scandal, where a company called Allied Crude Vegetable Oil Refining Corp defaulted on massive loans, and American Express's warehouse receipts, which they had guaranteed, turned out to be for worthless water under a thin layer of oil. People thought American Express was going to go bankrupt. The stock plummeted. Everyone was selling. But Charlie and I looked at the fundamentals. American Express had a powerful brand. People trusted their credit cards and travelers' checks. Implicitly, they had a strong franchise in a growing economy. We believed the public would forgive them, that the brand would endure. We invested a significant portion of the partnership's capital, around $13 million, buying it when others were fleeing in terror. That investment paid off handsomely, proving that when a fundamentally strong business faces a temporary problem, it can be a golden opportunity. That's being greedy when others are fearful, but it only works if the underlying business is truly wonderful and the problem is surmountable, not existential. It wasn't a cigar butt, it was a temporarily damaged, wonderful business. That's a crucial distinction. We had to understand the business, its competitive advantages, its balance sheet, and its management. And we concluded that the franchise value was intact. It's a reminder that market prices are often driven by emotion, not by logic. And if you can keep your head when others are losing theirs, you can find great opportunity. Now look, if you're a young investor today, or even an old one, the biggest piece of wisdom I can offer is this: ignore the noise. The financial media, the daily market gyrations, the constant predictions, it's all just noise designed to get you to do something. But the best thing you can do most of the time is nothing. Find those wonderful businesses, buy them at a fair price, and just sit on them. Our favorite holding period is forever. You don't need to do extraordinary things to get extraordinary results. What you need is patience, discipline, and the willingness to be greedy when others are fearful, and fearful when others are greedy. It sounds simple, and it is. The hard part is the psychological fortitude to stick with it when everyone else is panicking or getting euphoric. People think you need to be constantly trading, constantly looking for the next hot stock to get rich. They think you need to understand derivatives or complex algorithms. That's just not true. You don't need fancy math or a PhD in finance. What you need is a sound business mind, a basic understanding of accounting, and emotional stability. I spend 80% of my day reading annual reports, 10Ks, industry journals, newspapers. I'm trying to understand businesses. If I don't understand it, I don't invest in it. That's our circle of competence. I don't try to guess what's going to happen tomorrow in the market or next month. I try to understand what a business is truly worth today based on its ability to generate cash flow in the future. Ben Graham taught me the most important concept in investing, the margin of safety. Price is what you pay, value is what you get. If you want to buy something for significantly less than its intrinsic value, imagine Mr. Market, a manic depressive fellow shows up at your door every day offering to buy or sell you your share of a business. Some days he's ecstatic and offers a crazy high price. Other days he's depressed and offers a ridiculously low one. You don't have to listen to Mr. Mark. You can tell him to buzz off. You only deal with him when he's offering you a bargain. And if he's not offering a bargain, you just go about your day. You calculate what you think the business is really worth, independent of Mr. Market's mood, and then you only buy if the price is significantly below that. That margin of safety protects you from your own mistakes and the inevitable uncertainties of the future. This applies to any business, not just investing in stocks. What really matters in business is building something durable, something that creates value for customers, and something that has a sustainable competitive advantage. It's about having a product or service that people need or want, that's hard to replicate, and that can generate good returns on the capital invested. Look at Geico, for instance. We bought it outright in 1996, but I first invested in it way back in 1951 on Ben Graham's advice. I saw then that it had a cost advantage, selling direct to preferred customers, avoiding agents' commissions. That was a competitive moat. I sold it too early, another mistake of impatience. But later, when we had the chance, we acquired the whole thing. It's a business that still has a very strong moat because of its low-cost distribution model and brand recognition.
The quality of management is also paramount. I'd rather have a wonderful business run by an average manager than an average business run by a wonderful manager. But the sweet spot, of course, is a wonderful business run by a wonderful manager. We look for integrity, intelligence, and energy. We want managers who think like owners, who allocate capital wisely, and who care about their shareholders. At Berkshire, we delegate heavily. We hire good people, give them autonomy, and let them run their businesses. Ajay Jain runs our insurance operations brilliantly. He's an unparalleled genius in that field. Greg Abel is overseeing all our non-insurance businesses. We empower these folks because they are truly exceptional and understand their specific businesses better than I ever could. That's how you scale a business without getting bogged down in bureaucracy.
But that's not the only lesson I learned the hard way. There's another kind of mistake that sticks with you, a mistake of omission, the opportunities you didn't take. It reminds me of the story of our failure to buy more Geico back in the day, or not buying Walmart stock when it was clear what Sam Walton was building. Sometimes the biggest losses are the ones you never realized, the mountains of money you could have made if you just understood and acted. The silent $100 that could have grown into millions if you just let it sit and compound. The cost of inaction can be just as high as the cost of a bad action. One of my biggest mistakes of omission was perhaps not recognizing the power of the internet earlier. For a long time, I stayed away from technology companies because I didn't feel they were within my circle of competence. I didn't understand how to predict their long-term competitive advantages. And for many tech companies, that was the right call. The pace of change was too fast for me to grasp with any certainty. But then came Apple. Now, I'm not investing in Apple because I understand microchips or software development. I'm investing in Apple because I understand consumer behavior. And Apple has an incredibly sticky ecosystem. People love their iPhones. They practically live on them. It's a product that has become indispensable to millions, perhaps billions of lives. That's a powerful brand, a powerful product, and a powerful moat. When we started buying Apple shares in 2016, we did it because we saw it as a consumer products company with enormous brand loyalty, not just a tech company. It's a bit like Coca-Cola in that sense, but with even greater pricing power and customer retention. You see, the businesses I understand best are the ones where I can reasonably predict what they'll look like in 10 or 20 years. Will people still drink Coke? Absolutely. Will people still love their iPhones? Very likely. Will they still buy See's candies? You bet. That predictability, that stability is what allows you to sleep well at night, knowing your investments are working for you, compounding away, undisturbed by the daily market chatter. It's not about IQ. I've seen people with 160 IQs fail spectacularly in investing because they couldn't control their emotions or they tried to make things too complicated. The market is there to serve you, not instruct you. It's a place where prices are quoted, and sometimes those prices are very attractive, and sometimes they're absurd. Your job is to ignore the daily quotes and focus on the underlying business. If you buy a business at a good price and that business keeps doing well, generating more cash, then your investment will eventually reflect that. Compounding is truly the eighth wonder of the world. Albert Einstein might not have actually said that, but it's true all the same. If you start with a small sum and let it compound at a decent rate over many decades, you'll end up with a mountain. I mean, think about it. If you save just $1 a day from a young age and invest it wisely, letting it compound at, say, 10% per year, you'd be astonished at what it turns into by the time you're my age. That's the power of time and consistent, reasonable returns. You don't need to hit home runs every time. A steady stream of singles and doubles will win the game. And remember, rule number 1, never lose money. Rule number 2, never forget rule number 1. What that really means is protect your capital. Don't take unnecessary risks. Avoid permanent impairment of capital. If you don't lose money and you let compound interest do its work, you'll do just fine. Avoiding debt is another fundamental principle. I've never borrowed significant money personally to buy stocks. Charlie and I are naturally cautious. Leverage can amplify returns when things are going well, but it can utterly destroy you when they turn sour, which they inevitably will from time to time. We saw that in 2000. Many brilliant people, highly leveraged, lost everything because they were betting with borrowed money. At Berkshire, we always keep a mountain of cash on hand, ready for when opportunities arise, ready for when the market throws a tantrum. Cash, like a good defense, is crucial. It gives you optionality and it lets you sleep at night. Reading, as I mentioned, is how I spend the bulk of my day. I probably read 500 pages or more every day. It's how I learn, how I find new ideas, how I understand the world and businesses. You don't know what you don't know, and reading is the best way to fill those gaps. I read annual reports, industry publications, biographies, history books. It all feeds into understanding human nature, understanding businesses, and understanding markets. It's like gathering puzzle pieces every day. Eventually, you start to see the bigger picture more clearly. When it comes to my own lifestyle, well, I still live in the same house in Omaha I bought in 1958 for $31, $2, buy a Thorson for 31 bucks. No, not really. Oh, well. I drive myself to the office every day. My diet consists of plenty of Cherry Coke, See's Peanut Brittle, Dairy Queen Blizzards, and McDonald's. It's not a complicated life. I find joy in my work, in thinking about businesses, in my family and friends, and in playing bridge often with folks like Bill Gates. The money, it just happens to be a byproduct of doing what I love. And 99% of my wealth is going to philanthropy, much of it through the Bill and Melinda Gates Foundation. That decision, working with Bill and Melinda, changed my thinking about the responsibility that comes with great wealth. It's incredibly satisfying to see that capital put to work improving the lives of others, tackling some of the world's toughest problems. After over 70 years of doing this, here's what I know for certain. The fundamentals of investing never change. Human nature is constant. People will always get greedy, and they will always get fearful. That creates opportunities for the patient. Disciplined investor. The trick isn't to be smart. It's to be rational and to understand what you own. You don't need inside information. You don't need to follow the herd, and you certainly don't need to try to predict the future. Focus on the present value of future earnings of good businesses. I'm 93 now, and if I could tell young investors one thing, it would be this. Start early. Read everything you can get your hands on. Develop good habits and understand what you are doing. Invest in yourself first, your education, your health, your skills. And when it comes to stocks, think of them as pieces of real businesses. Buy them with the intention of owning them forever, just like you would a farm or an apartment building. Understand the business, understand its economics, understand its management, and buy it for less than it's worth. I'd never bet against America. Our economic system, for all its flaws, is still the greatest wealth creation machine in history. The human ingenuity, the drive to innovate, the adaptability, it's all there. There will be bumps in the road, there always are, but over the long term, the American economy will continue to prosper. Be an optimist, but be a rational optimist. Believe in the future, but be prepared for the present.
You don't need to be brilliant. You don't need inside information. You just need a temperament that is suited to investing patient, rational, and independent. Block out the noise, ignore the daily headlines, and don't let your emotions dictate your decisions. Find those wonderful businesses with wide and durable competitive moats. Buy them when Mr. Market is having one of his depressive episodes, and then just sit back and let the magic of compounding do its work over time. It's a simple game, but it requires incredible patience and discipline. It's all about value, and Ben Graham showed us the way to find it. Just make sure you understand the business you're valuing.